What's good, y'all? So today I'm going to be sharing with y'all my analysis and execution on a trade that I took yesterday that made me about $950 in about 10 minutes. This is on the NASDAQ. That's all I trade is the NASDAQ 100 futures. So that being said, let's kind of get into the chart. So I have here pulled up a daily chart on the NASDAQ. And the first thing you'll kind of see is on this daily chart, we swept the all-time high liquidity that was formed back in July of this year, right? So this was our previous high that we just recently swept on Monday, November 11th. So going into the day on Thursday, I was still, definitely anticipating lower prices potentially because, well, there's a couple reasons. So first, let me kind of mark this out. So like I said, all-time high liquidity was here. So we can go ahead and mark that. Let me put this here. So this all-time high buy side liquidity. So we purged that on Monday. And when we purged that, again, like I said, I was short. My bias was short. My bias was bearish. After that, I was looking for lower prices. So looking at our daily chart, you can kind of see here, we had this daily imbalance here, right? This buy side imbalance, sell side inefficiency, which is pretty much this gap you see here between these two candles. Between this candle's high and this candle's low, we have this gap that becomes a buy side imbalance, sell side inefficiency. So I'll go ahead and mark that out. So this is an area that the market could potentially always reverse off of. So I was watching to take shorts only in a premium area. I didn't want to be short anywhere in here. I wanted to be short in a premium area, meaning above our range, right? So above the 50 percentile of our dealing range. So what is a dealing range? Well, if we go into our hourly chart, because that was primarily what this thesis was based off of. This trade idea was primarily based off of the hourly chart. So you can see here, we still have our all-time high liquidity level marked here from that January level where we purged those buy stops on Monday morning, and then we sold off into this daily imbalance here. So as you can see, this going into, so I have my calendar or my trade chart set on market replay so that I can kind of walk you through what this looked like live in real time. So you can see here that going into the day, I'll kind of fast forward this. This was Wednesday afternoon, right? So Wednesday afternoon, this is what I noticed. I noticed that these lows had been swept and this high as well as these highs, right? So this liquidity up here had been swept by our run up on Wednesday afternoon, and these lows here had been swept, right? So these lows were swept, and this high was swept, and these highs were swept. And when that was swept, that left these two relative equal lows here. So these lows are too smooth. In fact, when I saw the market come down here on Wednesday morning and not sweep this low, I knew we were going to revisit this low at some point because this is just way too smooth. In the same way, these highs were way too smooth. The market hates leaving smooth highs and lows. It hates leaving smooth edges. It wants to make smooth edges rough all the time. So, like I said, these lows, these sell side liquidity lows, so I'll mark that sell side liquidity. That's essentially our sell stops that we had resting under there. Got swept at 10 a.m. as you can see here on Wednesday. Once they got swept, we reversed and went and swept this internal buy side liquidity. So this buy side liquidity was then swept at 1 p.m. on Wednesday. So when I saw that, that essentially formed what's known as a dealing range. So a dealing range is any range that sweeps a high and a low. It's any price run that sweeps a high and a low. So if you take this price run here that swept the low, right? So from this low, because this is the one that swept this low and this low, these two lows got swept by this low here, all right, this candle here. If you take this price run and put a Fibonacci retracement on it to essentially grade it, right, and see where the percentiles of each price run are at, then you'll see something very interesting here. So I'll show you. So if we take our fib retracement here, and mark this here. What do you notice here? This, give me a second to adjust this. This here, this line, this middle line here is the 50 percentile mark of this price run, right? From this low to this high. That's the 50 percentile mark. So whenever you're trading, one of the first things you need to understand, one of the key concepts to understand is that you don't want to be short in a discount area, right? So a discount is anything below this, the 50 percentile mark of your dealing range, right? So you never want to be short in here, right? You only want to be long down here, ideally, if the setup says to go long, right? But if you're wanting to be short, right? If your bias is short or bearish, right? You think the market's going to go down, you should be shorting above the 50 percentile of this dealing range, right? So this level at 21,162.5, right? That becomes essentially our line in the sand, right? So I'm short above here and I'm long below here. If I'm long, my bias wasn't long, my bias was short. So since my bias is short, I know, okay, going into Thursday, I'm looking for a short setup above this mark right here, right? I'm looking for a short setup above there. So let's kind of fast forward along and see how this played out. So this was at this point 4 p.m. on Thursday, or sorry, 4 p.m. Wednesday afternoon. So the market had just closed Wednesday, and I'm kind of looking to see what's going to happen on Thursday. So let's go to our overnight setup. So this is kind of overnight. It's just kind of not really doing much. You can see we're staying in that dealing range. And notice that we come down into a discount, right? We're in a discount. The market reverses back up into a premium. So now let's see what happens. And this is 3 a.m. in the morning. So this is the London session. So I'm not trading this, obviously. So you could see what happens. Market rejects here, right? So you can see that there's definitely some bearish pressure here. The market is still, it's not showing any strength really. We didn't take a low. We haven't really taken a high. We're still kind of in this range, which is great for me, right? So kind of just moving along. So now we're getting into the morning, right? New York open or the New York morning session. So here is 7 a.m. So 7 a.m., 8 a.m., right? I believe we had data at 8 a.m. on, right? So if we go now to let's go to our 15-minute chart and look at this, right? So everything's still the same. This is just a 15-minute chart. So now you can see that we had some data come out at 8:30 in the morning. Actually, let's go to our 1-minute chart. You can see this more clearly. At 8:30, you can see we had PPI data come out at 8:30 a.m. on Thursday. So that data, I knew we're going to form a range off of that data. So these highs now become our data highs. So you can see we formed right at 8:30 when that data released, we formed here this 1-minute sell side imbalance, buy side inefficiency, which is essentially, a fair value gap that was left, a bearish fair value gap, right? Remember what I said, it's this gap between this candle's low and this candle's high. So I knew this would be an interesting area I'd be watching. And we also formed these two highs here that I knew if we wanted to go down some more, the market was going to potentially look to come take these highs. So let's kind of fast forward into our 9:30 open to show you what I was looking at. So remember, here's our dealing range. Remember that entire price run that I showed you. Here it is, just on the 1-minute chart. This entire price run from this low at 10 a.m. to this high at 2 p.m. That price run is a dealing range because we took out this low and we took out those highs. So that's our dealing range. So again, we want to be short above here if we're bearish. And if we were bullish, we'd want to be long below here. So now that being said, let's fast forward. We got our data. It's now 9 a.m. Let's fast forward and see kind of what plays out. So kind of just chopping around. Market opens at 9:30 a.m. And I can kind of show y'all what happens. So at this point, I know this is what I'm thinking when the market is about to open. We have here our bearish fair value gap, right? The sell side imbalance, buy side inefficiency. And we have a high right here and a high right here. That is a perfect recipe for turtle soup. Perfect recipe for turtle soup right there. So I'm watching for that. So essentially what I did, and I literally did this yesterday. I will show you. I had a limit order waiting, and I don't do this often, but when I'm super confident in a setup, I will potentially do this with a tight stop. I had a limit order waiting here at the consequent encroachment of this, right, SIBI, right? Because I knew if we were going to sweep this high, what is a good premium array for us to sweep into? Well, definitely this SIBI for sure, right? This sell side imbalance, buy side inefficiency that happened to be at the PPI data highs. And I knew it could come into this consequent encroachment of this level. So that being said, consequent encroachment became my limit order. So what I did was, I don't know if I can do that. Let me see if I can put a limit order here. I don't know. I had a limit order there. I can show you all the screenshot. Now let's see what happens here when we open the market. So you see we popped into here. Immediately the market ran. When you see a strong move like this, you have to know this is a liquidity move. This is strictly to grab liquidity. They're trying to go get all these stops, right? Because people are also short, but they had their stops sitting up here. Because as soon as that data came out and they saw that drop, people were short. They put their stops up here. The market rips up to go get those stops. It goes really quickly because it doesn't want people to get in to take their stops out. It wants to get their stops. So I'm going to go short here. One, I added my first one really at 66, at 67, like I said, at the consequent encroachment level, but I can't really show that on market replay. So I'll just show you kind of what I did here. So now I added one here and I was targeting these data lows, right? Because remember the data came out at 8:30. Typically the market seeks the highs and then goes and seeks the lows. So I was targeting these lows at 113 and then potentially even our London lows here at 2 a.m. at 21,090. So I'll show y'all what happened. So I'm entering short because now remember, this is 50%. You want to be short above your dealing range. You want to be short above your dealing range. I had a limit order sitting here because I was confident in this trade. You want to be short above your dealing range. I was short at above this 50 percentile level, right? At 162. So let's see what happens and how does this play out. So you see we got the strong push down. I didn't sell here. I was still holding, got another push down. At this point, I was up about 500 because remember I got in a little higher, but I was so confident this was going to the lows. I did not sell. So you can see we come back. Now, when we come back, this is where you have to be very, very, very. I have my stop loss set here. My stop was right above these highs. Really, it was right above this volume imbalance. If you see here, this volume imbalance here, the gap between this candle's open and this candle's close is a volume imbalance. I knew that if the market was going to go down, there was no reason for it to go above this volume imbalance. That was pretty much the last line of defense. But what happened was something very interesting. And this is where experience really plays a role, right? Because if you can see here, let's fast forward this, you see we get the rejection, but what does the market do? It comes higher. And at this point, you see where it came. It came here, right? Look at what it respected. Look at what this respected. This is a volume imbalance. It respected it literally to the tick. This is algorithmic. And this is why I had my stop loss here, right above it. So I knew if I'm wrong, it should come up. If I'm right, it shouldn't come up higher than this. Now, potentially it could have came and grabbed these stops and then went down and I would have just re-entered. I would have took a small loss and then re-entered. Because remember, I got in at 67. My stop loss was at 75. That's not even a 10 point. That's not even a $200 loss. So that's literally peanuts. I wouldn't have been worried about it. I would have just re-entered when I saw this. So what I did though, when I saw this, I also noticed something else on the NASDAQ, on the S&P. So if I show y'all the S&P now, this is the same high right here. If you see on this right side, I opened up the S&P. You see this high? This high here is this candle. So this high on the NASDAQ at 937 is this candle here. So as the NASDAQ was pushing higher, S&P was pushing lower. This gave me confidence to hold this because although it went high, that is an SMT. So that tells me that the markets are, that's essentially a good indication that the markets are correlated, right? Or inversely correlated, depending on how you're looking at it. So when one asset makes a higher high than the other, that's a good indication we could go lower. And vice versa. If you're bullish, if one asset makes a lower low than the other, that's a good indication you could go higher. So because of that, I was pretty confident to hold this as well. So you can see I had a lot of confluences, a lot of things that made me pretty confident to hold this. We had this data high SIBI. We had a SMT here. We had 50% of the dealing range where I was short. We had this volume imbalance we respected. And then we also are coming off of all-time high liquidities. So I'm pretty confident in this. So at this point now, what I did here is, now just keep one open now so you can just see this chart. At this point, what I did now is I added a second contract here. So I'll go ahead and add one here, and that's about where I added it. And you can see at this point, we got a really good sell-off here. Really, really good sell-off. So I sold one at about that low here. I took one off here. And I'm not gonna lie, I should have probably held this longer. Actually, I definitely should have held this longer, right? But I took one off here. And then I took the other one off about right here. So again, my target were these lows here, right? I was targeting this internal sell side liquidity. So those lows there were what I was targeting. So you can see what I really should have made on this trade was, something much higher. So you can see here, I'm 2,500, would have took them off there essentially. But this trade did end up going to London lows. It took a little while longer, but it did happen. And then we ultimately ended up hitting our previous day low on that Wednesday low. That one took much, much longer, but that would have been a good target here as well. So you could see if I did execute this the way I should have and held it as long as I should have, you could see we would have taken out that load right here. And I would have exited that one there. And essentially that'd have been a $2,700 trade. I only made about 1,000 on it, but it should have been about a $2,700 trade. That's, just poor execution on my part more than anything. I still had a great risk to reward. I wasn't mad at it, but I definitely am still working on holding my trades a little bit longer, especially, in certain accounts. So that was essentially what I did to, make $1,000 in literally, like I said, I entered at 9:30. I was out by 9:40 in 10 minutes. $1,000 in 10 minutes. I mean, I don't know what job is paying you that. This is why trading is literally the best job in the world if you learn it. It's not even a job, but it's the best thing in the world once you learn the skill, because no one can take the skill away from you. So that's about it. I know this is a lot of information. I know a lot of this is new for a lot of people. But again, once you understand the concepts and you've, kind of done this for some time, you will be able to see things clearly just like this as well. You just have to be patient with yourself and you can't give up. This was a great trade. And I mean, they're not always this easy and this clean, but when they are, these are when you got to be confident and get in and just execute. So that's all I have for this one, but definitely going to be having a lot more recaps and videos coming for y'all as far as trades I'm taking. So stay tuned for that.